Bernie Madoff was sentenced for 150 years in prison in 2008 for running the biggest fraud scheme in US history. He profited over $65 billion over the decades he ran by undetected. This is how he did it. Ponzi schemes are run off the principle of boasting far superior returns in reality and using the revenue from new investors to pay off the promised returns of older investors. The principle is exasperated when the scheme encourages investors to stay in the game and avoid reclaiming their profits in order to maximize their earnings. Although highly profitable, Ponzi schemes are very unsustainable due to the high amount of cash flow required to keep them going. Usually they will fall apart after new investors become harder to find or if investors suddenly start pulling their money out. At this point, the operator will take the remaining investment money and run away. So how did Bernie Madoff manage to run his Ponzi scheme for so long? Madoff started his own firm which specialized in market making in 1960, and he was a key contributor in the launch of the Nasdaq stock market. As he played such a key role in starting it, he became a chairman of the Nasdaq board and advised the SEC. The company Madoff founded was Bernard L. Madoff Investment Securities LLC, and the firm was one of the top market makers in Wall Street. In 2008, it was the 6th largest in the US. This aspect of the firm was completely legitimate, and it's a key factor to how Madoff was able to keep the scheme running for so long. The strategy that Madoff employed was an investment pitch consisting of purchasing blue chip stocks and taking options on them. This is often called a split strike conversion, or a collar. In an interview with the Wall Street Journal, Madoff claimed that he placed invested funds in convertible arbitrage positions in large cap stocks, which promised investment returns of 18 to 20%. At the time, the market return from the S&P 500 was approximately 16%, so the profits were only marginally higher than the market. Madoff claimed that by stock picking and market timing, he was able to beat that market by a thin margin and provide the superior returns. At the time, there was a federal law requiring private institutions to pay out 5% of their funds each year back to the investors. This is known as the 5% payout rule. This essentially meant that if Madoff took $1 billion in investment, he was required to only pay out $50 million per year. And even if no extra investment came in, he was able to keep that scheme going for 20 years until that $1 billion ran out. Madoff would then target charities in order to avoid the threat of sudden or unexpected withdrawals. Madoff was also a master marketer. His fund was considered very exclusive, giving the appearance of a velvet rope. He would market his investment method as too complicated for outsiders to understand, and would generally refuse to meet directly with investors, which gave him a very mysterious aura and increased the allure of his investments. Some Madoff investors were wary of removing their money from his fund in case he would not let them come back in later. Another reason Madoff was able to go by unnoticed was that his returns were unusually consistent, at around 10% net. Most Ponzi schemes will typically claim returns of 20% or higher, and hence they collapse quite quickly. In a New York Times interview, an unnamed investor remarked, "The returns were just amazing, and we trusted this guy for decades. If you wanted to take your money out, you always got your check back in a few days. That's why we were all so stunned." Now you might think that the investors would have been a bit skeptical about how he consistently received high returns. The typical explanation for Madoff's returns was that he was leveraging his legitimate brokerage business and exercising an illegal market advantage known as front-running. Front-running is very similar to trading on insider information. It is the practice of entering into a trade to capitalize on non-public information of a large pending transaction, which will influence the price of that security. For example, if someone had made a big trade with Madoff's brokerage firm, his trading firm would then have advanced knowledge on what would happen to the price of that stock. Hence, they could capitalize on that. However, in his guilty plea, Madoff admitted that he hadn't traded since the early 1990s and that all of his returns since then had been completely fabricated. Additionally, the Madoff family gained unusual access to Washington's lawmakers and regulators. Firstly, Madoff himself sat on the board of directors of the Securities Industries Association, which soon formed SIFMA. The Madoff family maintained long-standing high-level ties to the Security Industry and Financial Markets Association, which is the primary securities industry organization. This allowed Madoff to easily slide by whenever the regulators would have a closer look at his firm. So how did he eventually get caught? The scheme began to unravel in 2008, when clients requested $7 billion and he only had $200 million left. This all started from the general market downturn of the global financial crisis. As the market's decline accelerated, more and more investors tried to withdraw cash from the firm, and Madoff struggled to find new investors to pay out these withdrawals. By December, the account that Madoff used to pay off investors that had over $5 billion in early 2008 now had less than $200 million. Knowing that the scheme was on the brink of collapse, Madoff asked his sons to follow him to his apartment, where he admitted that the asset management arm of the firm was all one big lie, as he put it, and asked his sons to wait a week before alerting authorities. Instead, his sons immediately called the lawyers, and the next morning, Madoff was arrested. Madoff pled guilty to 11 counts of federal crimes and admitted to operating the largest private Ponzi scheme in history. In June 2009, he was sentenced to 150 years in prison. Thank you for watching. If you enjoyed, please let us know in the comments, and feel free to watch some of our recent videos. We specialize in teaching you the things that you'll never learn in an economics class that we all love learning about, and we hope you enjoy the videos.